What exactly is GAAP? GAAP, or Generally Accepted Accounting Principles, is a collection of rules that guide how financial statements should be recorded, organized, and presented. These standards help ensure that businesses across the United States follow the same approach when reporting their finances. Without GAAP, companies could present their numbers in ways that make comparisons difficult or misleading. GAAP sets expectations for how revenue is recorded, how expenses are reported, and how assets and liabilities are measured. It also outlines how financial statements should look so investors, lenders, and regulators can trust that the information is consistent and reliable. At its core, GAAP exists to create clarity. When businesses follow the same accounting rules, financial statements become easier to read, easier to compare, and easier for decision-makers to rely on. The origins and importance of GAAP was created to restore trust in financial reporting during a period of major economic instability. After the 1929 stock market crash, investors needed consistent rules that would make financial statements clearer and more dependable. GAAP was introduced to standardize how companies recorded and presented financial information so investors could compare businesses with confidence. Today, the Financial Accounting Standards Board oversees GAAP in the United States. These standards are essential because they set a uniform structure for preparing financial statements. This consistency allows lenders, investors, and regulators to understand a company's financial condition without confusion. When you look at a balance sheet or income statement, the reliability of those numbers comes from GAAP. It is the framework that keeps reporting transparent and structured across all industries. Basic principles of GAAP is built on several core principles that guide how financial information should be recorded and reported. The principle of regularity requires accountants to follow GAAP rules at all times, ensuring consistency across financial records. The principle of consistency makes sure accounting methods do not change from one period to another. This stability allows users of financial statements to compare results over time without guessing whether methods shifted. The principle of sincerity requires honest and accurate reporting. The goal is to present a company's financial condition as clearly as possible, without exaggeration or selective reporting. The principle of permanence of methods supports the use of established accounting procedures. When methods stay the same, the financial story remains stable and predictable. The principle of non-compensation prevents companies from hiding losses by offsetting them with unrelated gains. Each item is reported separately so financial statements remain clear. The principle of prudence encourages cautious reporting. It prevents assumptions about income that has not yet been earned and ensures that expenses and liabilities are recorded promptly. How GAAP affects businesses. GAAP influences how companies record transactions, prepare statements, and communicate financial results. When businesses follow GAAP, their reports become easier to interpret and compare. This clarity matters to anyone evaluating the company, whether it's a lender reviewing a loan application or an investor considering future potential. GAAP also supports stronger decision-making. Management uses GAAP-compliant financial statements to monitor performance, plan budgets, and set long-term goals. Because the data is structured and consistent, it helps leaders understand where the business is strong and where adjustments may be needed. Overall, GAAP helps create reliable financial reports that support better planning, build trust, and reduce confusion in the marketplace. The future of GAAP continues to evolve as the business world changes. The Financial Accounting Standards Board regularly updates the rules to reflect new financial practices, economic conditions, and emerging industries. There is ongoing discussion about aligning GAAP with international financial reporting standards so companies operating globally can use one set of standards instead of two. While full alignment has not happened yet, efforts toward greater compatibility continue. Despite updates and changes, the main purpose of GAAP remains steady: provide financial information that is structured, reliable, and clear. As technology advances and businesses become more complex, GAAP will adapt while still maintaining the principles that keep reporting grounded. GAAP versus non-GAAP reporting. GAAP reporting follows established standards and provides dependable, comparable financial information. Non-GAAP reporting, on the other hand, allows companies to present additional metrics that GAAP does not require. Non-GAAP figures often adjust earnings by removing certain items, such as one-time expenses or non-cash charges. These measures can offer a different view of performance that management believes reflects the company's direction more accurately. However, non-GAAP reporting has no consistent rules. Because companies can define these measures in different ways, comparing one company's non-GAAP results to another's can be difficult. Non-GAAP reporting is useful for context, but it should never replace GAAP. If this video helped you understand accounting a little better, don't forget to like, share, subscribe, and turn on notifications for more accounting tips and guides. See you in the next video.